China's alignment with Russia as it began its war with Ukraine has further emphasized its ideological and geopolitical differences with the U.S. China's President Xi has said that the standoff between countries over their alignment in the Ukraine war could be more damaging to the world peace than the war itself. This additional uncertainty is clearly unsettling for investors. Is escalating tension now the only prospect for U.S.-China relations? How will it impact global trade and security? What does it all mean for global portfolios? The U.S.-China differences over Russia are merely the latest development in a momentous struggle between the world's two economic superpowers. We call this struggle G2 polarization, and it is playing out on many different spheres, including trade, financial markets, technology, military capabilities, and diplomatic influence. While highly distracted by domestic COVID challenges, China is seeking to become the dominant power in its home region and beyond. We believe this rivalry will continue to intensify, with each side trying to advance its own interests and block the other. Importantly, though, intensifying rivalry doesn't make a full-blown conflict between the US and China inevitable. Instead, we have long believed tough strategic competition the likeliest outcome. While the Ukraine standoff has accelerated G2 polarization, our core views remain the same. Despite U.S. warnings, we don't expect China to be sanctioned this year in relation to Ukraine. With inflation uncomfortably high, avoiding further disruption to trade and business is key. That said, though, we don't expect much of an improvement in G2 relations for now. Where there are deals to be done over trade and financial market access, we think these will have to wait until after U.S. elections in November. We also believe the immediate probability of a conflict over Taiwan to have declined even further in the short term. The Chinese authorities are preoccupied with COVID-related challenges that are creating a second severe shock in China's economy in just over 2 years. However, COVID has been lasting and decisive nowhere. Policymakers are priming stimulus, which is likely to be more effective when lockdowns end. Will this occur before a key gathering of the ruling Communist Party? The world will be watching. For now, at least, we therefore look for relative stability in U.S.-China relations. G2 polarization is related to an unstoppable trend we call the rise of Asia. Asia is well on the way to becoming the foremost region in the global economy. As ever more Asians join the middle class, we expect consumption to grow significantly. Currently, China's economy is under pressure from its ongoing COVID lockdowns. Elsewhere, though, the bounce back from COVID is well underway, especially Southeast Asia. Once China eases its lockdowns, we look for recovery in the second half of 2022. In this environment, we see potential opportunities for investors near-term and long-term. Global investors frequently have far too little exposure to Asia or none at all. As economic power continues to shift towards the east, we think this will prove an increasingly expensive mistake. As of mid-2022, we see Chinese equities trading at deeply distressed valuations. Among the areas we find most attractive are those linked to economic reopening, green energy, technology, and more broadly. Across Southeast Asia, we favor investments linked to tourism, natural resources, and industrial diversification away from China. Is your portfolio oriented for the rise of Asia? Let us show you how.